Hi everyone, welcome to this live webinar. Well, I want to discuss the best investment opportunities at the moment, and you should all be able to see and hear me loud and clear. So if you wouldn't mind, it would be fantastic if you would put into the chat that you can see and hear me clearly. Grab a notebook and pen because you'll want it for this. You'll also want to take some screenshots of what I'm going to show you for the obvious reason that there's quite a lot of information I'm going to put through on this. And one of the problems we're going to address is this problem of fear of missing out. You know, when we see returns like this over just 5 days, we think to ourselves, well, wait a minute, how do we get in on it? And I'll share my screen with everyone as well. So let me show you the screen. There you go. And one of the, thank you, Ravi, and thank you all. And let me know where you're from as well. I want my webinars always to be interactive. So I want to know where people are from, please. That's always incredibly helpful if I know where everyone is from. So do let me know where you're from, which parts of the world. That's always handy. Right, like I said, we're dealing with this issue of, okay, what are we going to do about the fact that we see these returns and the problem becomes, well, that's all very well, me telling you the ones which have just risen in the past week. There's 9,000 odd stocks on the on the US markets, the UK markets, and international stocks listed in the US markets, like Alibaba, for instance, or Infosys, or whatever. So it's all very well saying, well, there were 11 which went up over 100% in the last 5 days. How the heck are we going to pick them from this massive list of about 9,000 that exist out there? How do we narrow that down? How do we filter that? What should we look for? What might give us an edge? And also, we don't want to be chasing our tails. We don't want to be trading and dipping into one, missing it, getting in too late, then jumping into another just as everyone else is selling. We don't want to be doing that either, okay? So how do we avoid all those problems? So that's what we're going to cover in this. The first thing I want to say is I have no conflict of interest with you. I am not a long-only retail fund manager. None of our funds are available to the retail client because they're hedge funds, and so it's actually a criminal offense to offer those to retail clients. And I don't have any long-only funds, retail funds, okay? So we've got no conflict with you. I'm not a broker, so I'm not trying to get you to trade through my brokerage either, okay? So there's no conflict of interest with you. My background, I used to be a retail investor, so I used to be a trader as a retail trader, and then I set up my asset management company. We now have various funds in private equity and in hedge funds, and there's our little offices. I wish I owned the whole building. I don't. It's on Brook Street. We have a little room out there, okay, which we rent. We pay about £15,000 in rent a month. I know. How stupid is that? I agree with you. Okay, I wish I owned the whole building, but I don't own whole buildings in Mayfair, I'm afraid. The other thing I've got to say to you in this presentation is this. I can't give you individual advice in this. I don't know who you are. There's hundreds of people on here, and I don't know who each one of you is individually. So when I show you stocks that I might own, which ones I might like, the latest data from Goldman Sachs, UBS, what hedge funds are putting money into, what the analysts are saying, what I'm hearing from my colleagues in the industry and where the smart money's going, that doesn't mean you should go out and do it because I don't know your specific details, okay? Hi, Sarup. So I just want you to bear that in mind. And also the other things it says is, please don't steal my presentation, but that's not really directed at you. Okay, so let's level up the playing field for you, right? There is a massive wealth gap, and I'll just zoom into this because some of you will be watching this on your phones and it can be difficult to see. One of the reasons which motivates me to do this is because I get really annoyed by headlines like this. And I don't know if you can see that headline, and I'll zoom in. Okay, UBS rich clients get Goldman PIMCO strategies with no extra fee. Now that annoys me because what that means is the rich continue to have access to data and information which everybody else doesn't. So I'm going to be a little bit of a Robin Hood, and I'm in a unique position because I went from being a regular private investor to being a hedge fund manager, so going from retail to institutional. And I'm going to share with you what we know, what we see. So like a little bit of a Robin Hood, I'm going to steal from the rich, like UBS and Goldman Sachs, and give to everybody else. All right, that's what I'm going to do. That's the whole point of it as well. Jasmindra, I'm going to do that in this as well. Okay. So this is one of my key motivations. I can't just wire money into your accounts, but what I can do is wire knowledge into your brains, and that's my job. Okay, my idea is to try and turn you in the next 60 minutes into, well, as close as you can turn somebody into an investment expert in 60 minutes, right? Now, we see headlines like this, and we think to ourselves, again, fear of missing out, what the hell's going on? S&P 500 hits records. How come my SIPP and ISA hasn't hit all-time records? How come my pension hasn't shot up, or my savings if I'm in my 20s? How come my trading account hasn't shot up when the market's rising? The other problem we have also, and the data I want to show you here, it might be a little bit difficult to see. All this says is we then think to ourselves, wait a minute, is the market at an all-time high? So we come out of the market a little bit, and what happens? We miss just one or two of the big trading days, and boom. Guess what happens? If you miss just the 5 best trading days over in the last 20 years, just the 5 best trading days, you'll have generated 50% less gains in your portfolio. You'll have lost 50% compared to what you could have had if you miss 5 out of 10 years worth of market exposure, just 5 of the best days. Right, so there's a problem that if we try and time, oh, well, the market's a bit expensive at the moment, I think I'll just dip out, I'll wait a couple of days, then I get back in. What happens? It goes and shoots up. So we've got to handle that. What's the best strategy to deal with that? Because, of course, we know the market may be toppy, and we don't want to just sit and watch it as it falls. But equally, as we come out, sod's law, it shoots up. What should we do in those scenarios? Okay, what should we do in those scenarios? And one of the other things I want to share with everybody is I'm going to put some polls up on the screen. Now, depending on where you're watching me, you'll be able to see those. Okay. And I share those with you because I want everybody else to see those as well, please. Right. So we've got to deal with that problem. And there's another bigger problem I want to try and solve for you, which is this. So investors then think it's all too complicated. I'll just give my money to fund managers. And what do they find when they do that and they give it to fund managers? What happens? Well, this is from the Telegraph just last month. Investors urged to move £50 billion. And I know I've got audiences from America, Australia, United Kingdom, and Europe watching this, and it's relevant for all of you. Investors urged to move £50 billion held in underperforming dog funds. Underperforming dog funds. And that's the problem with the fund managers. You're stuck with dog funds. So how do we deal with that? I'm going to deal with that in this webinar. There's another thing. The wealth gap. The top 20% of earners own nearly all the stocks held by US households. Now, this is the American example I'm giving, but it would hold pretty much true for the UK. So we know the rich are getting richer, and we know they're getting richer off the stock market. Okay, and they're pushing it higher. Well, that's not fair. What if somebody said to you, you're never going to be allowed to own a property? If you're never going to be allowed to own a stock? And that's what's happening, because what's happening is the regular people, not in the top 20% of earners, the regular people are giving it to fund managers or procrastinating and not doing anything at all. And so they're never getting their money to work hard enough for them, or by giving it to fund managers, they're making those fat cat fund managers get rich. Now, I can say that because I don't have a retail long only fund, and I never would do it because I think they're an absolute con. And I'll go into this webinar as to why I think long only funds are a con. I mean, one key reason is because you could just do it yourself. And it's a lot easier and cheaper to do it yourself than give it to an idiot fund manager. Okay. And you might think, well, why are you calling them idiot fund managers? It's not actually me. This was an article from September of last year. More than £1 trillion of Muppet money costing savers billions. Basically, there is, according to the Bank of England, £1.5 trillion of cash is now stored in saving accounts spread across ISAs, savings and current accounts, according to the Bank of England, an amount roughly equal to the combined value of all UK residential mortgages. That money is doing nothing. They've called it Muppet money, which could have been invested, by people. And you might say, well, no, some people might not want to invest it because they want the safety of a bank account. That's perfectly fine. But I bet you a lot of you don't. I bet a lot of you are thinking, actually, I want my money to work a bit harder. And I wish in the last 6 months, I got a 20% return, which would be in line with the market anyway, rather than it sitting in a bank account getting nothing. And this is the procrastination that comes from ignorance, and ignorance comes from a lack of information or confusion from the news stories, and fund managers just constantly advertising at you that they're the best, and then they blow up your money anyway. So I'm going to deal with all those problems. I'm going to show you hard data, and then I'm going to show you how you should be in charge. Let's start off by looking at something I can put in my SIPP and my ISA. So this can go in my savings account. Just because I'm in the UK, it makes no difference. Let's look at the S&P 500 over the last 3 months. Okay, it's not me making an earning by investing. It's these companies doing it for me. These are the last 3 months, right? So you've got Alphabet, which I happen to own, Microsoft I happen to own, Apple I happen to own, and you might think they don't pay the big bucks to just buy those, do they? No, there's lesser known names I'll come to in a second, which I own as well. But I'm just letting you know some of the things that I still happen to own. Amazon, I still happen to own, Facebook, Disney, Netflix. Netflix is in my son's account still. Okay, MasterCard, Visa. But I'll give you the lesser known names in a second, the more exciting names. And the funny thing is, the way I get my excitement is I tend to pick safer companies with lower volatility but good returns, like a Microsoft, and then I double leverage. But I'll come to that in a second, okay? So out of this, I know I've got a universe, and this is just the S&P 500. I know this can go in a SIP. I know it can go in an ISA. And this is just the last 3 months, okay, as well. And this can go, Jasminda, I'll because there's hundreds of people on here, I'll answer the questions at the end that you're asking on the various things, but do keep them coming so I know what to answer as we go forward. So the key question then becomes, well, how are we going to pick out of this universe? Because we know out of this universe lies our fortune. We know, a bit like a gold prospector, that there are some amazing returns to be had, but we don't want to be chasing our tail and gambling and speculating and trying to guess the next big news item. And we certainly know, as the data will show, we don't want to be giving it to a fund manager thinking that we're giving it to an expert and that will save us. And I'll show you the data on that as well. But the universe is even bigger than just 500 American companies. There's the whole world. Every single one of these companies is listed on the New York Stock Exchange, for instance. And that includes British companies like Rio Tinto, HSBC, and the like. So we know, okay, in the past year, AstraZeneca happens to be up 32%, or SAP is up 25%, TD is up 68%, not very surprising. Shopify up 254%, okay? But that's in hindsight. What about going forward? What about the individual stocks? How are we going to find these and pick these? And that's what I'm going to get down to, because again, people will wrongly say, oh, I'll just put it in a passive index tracker, which might be suitable if you are 80 years old. But if you're in your 30s or 40s or 50s, you probably want to have individual stocks in your portfolio. How many? Which ones? And I'm going to show you also that this notion that, oh no, if I give it to a fund manager and he's put it into 100 different separate individual stocks, I'm better diversified and he's looking after it for me. And isn't that clever? Well, I'm going to show you head to head how in actual fact that doesn't. It doesn't give you the performance and gives you the drag and doesn't give you the returns you want either. You might say, well, no, his job is not to give me performance. It's just to keep my money safe and pay himself fat fees and make sure that I don't lose any. Well, you can still do that yourself in any event. Okay, and save the fees. And so we'll do that comparison between an index tracker, an actively managed fund manager, and you picking it yourself. That's what we'll do. And if we were just to look at indices, even then, the problem that you're only looking at your own geography when you're investing is this. This is the poverty gap. This is why, for instance, people tend to, as we know, invest in their own geographies. So if you're British, you tend to, either through the fund managers you pick or your own stock picks, invest in your own country's stocks. If you're American, you happen to do American ones. Now you might say, no, Alpesh, I picked a Bailey Gifford growth Asian fund or emerging market one. Yeah, you probably put about 1% in there, or 5, maybe even 10. Okay, what I'm talking about, to be truly looking at a global group of stocks, 9,000 companies, right? And picking, and I'm going to explain to you how many it should be out of that and how we pick those. Well, even if we only did no better than an index, This over 5 years is the NASDAQ, 128%. I'm not saying you'd get into the NASDAQ today. I'm showing you over any rolling period, you were always far better off picking from a global group of companies than you were just, say, the UK market. Over any rolling 3-year period for the last 50 years, or any rolling 5-year period, or even rolling 1-year period. It is very rare to pick purely from the UK markets and outperform somebody who's picking from a global universe. And it's very simple. Why? Imagine that essentially what you're doing when you look at a portfolio is all you're really doing is hiring people to manage your inheritance, your future savings, your desire to be a millionaire or millionaire 10 times over in the future, or your children's inheritance. So you're interviewing these companies, and if you only interview from a particular market, so let's just be racist, you only pick them if they're British, okay? So you don't want any American companies or any Chinese or, God forbid, Italian or German or French or anything else. They've got to be British listed companies only. Well, you're picking from a narrow gene pool of companies, and it's by statistical chance alone, less likely you're going to pick companies which are going to outperform. But if you don't have to believe me on that, just look at the maths on this. It's 5-year period. My British friends have in the last 5 years managed to get minus 12% most probably in their pensions, whereas the Americans have managed to get anywhere between 50% in the S&P 500 and 128 in the NASDAQ. Well, we want to outperform an index because an index pulls good and bad companies. What if we could cherry pick from within an index like the NASDAQ and just pick ones which show even better traits? So we're doing better than the index. That's what we'd expect to do. Why can't we cherry pick from an index? Of course we can. With a tiny bit of knowledge, I can pick from and do better than ETFs, obviously, because you take their universe and you say, oh, cherry pick. And how do you decide what is cherry picking? That's what I'll come to in a second as well. Okay, so this poverty gap over 5 years, the American and the Brit, they did nothing else. This is all passive income. The American doubled his wealth and the Brit lost 12%. Let me tell you another worrying statistic. Most fund managers with whom your SIPP or ISA, the money goes and sits. Okay, it goes and sits with a fund manager. When they take the money out of your employment income or you're doing your own pension, you're investing your own pension, it goes with a fund manager. Okay, they tend to at best track the FTSE 100 because they've got lots of capital, so they can't go and buy smaller companies or even medium-sized ones because they've got billions of assets. So what do? They end up just putting it into the biggest companies, and so they track the FTSE 100, which is an index of the biggest British companies. Well, the FTSE 100 is at 1998 levels. So your pension will, at best, have probably tracked something close to that, right? You might have done a tiny bit better. Well, that's a problem. That's a problem because after 20 years, you've not had the kind of returns you should have had. Now, you can make excuses. At this point, there's about 10% of people, maybe 5%, who'll start making excuses for fund managers. They'll say, oh, no, but the poor dears, they deserve to get rich off my labors. No, that's wrong. It's just wrong, okay? I know my industry well enough to know that it's occupied by a lot of fat cats who don't deserve the pay they get. And I've been on Sky News and I've said it. I've been on the BBC and I've said it. And I'm in the industry, so I think I have bloody rights to say it. And yet people, because they're busy or for whatever reason, ignorance, will keep giving them the capital. So let's work it out. This is a typical bad portfolio. It's one which one of my students had sent me when he first sort of joined up to learn. Okay. And he sent me this portfolio and it worried me. It worried me. Because I said to him, why did you pick these stocks? And he said, well, Alpesh, they're big household names. Name recognition. There's Aviva, there's BAE Systems, Santander, Barrett, BP, BT, Centrica, Lloyds. And I said, you're right. Big names. But here's a problem. Did you know that the volatility of the stock compared to the returns you're getting is negative for virtually all of them? And he said to me, what now? And I said, you know, over the last 3 months, they're down between 40 and 50%, whereas mine have gone up to all-time highs. This was the time when the US market was making all-time highs. This guy was just going lower and lower. These weren't cryptocurrency speculative bets. Over 6 months, they were down between 40 to 60%. And these were household names. The safety of name recognition. He said, no, it's okay, Alpesh. Even though it's dropped 60%, I got a 2% dividend. Oh, you got a 2% dividend. That's great. Peter's asked a brilliant question. You mentioned overseas and US stocks can be put into an ISA or SIPP, but how can you do that? The same way you put in any other stock, the same broker. So let's say you've got Barclays as a broker, or Halifax, or Hargreaves Lander, or an AJ Bell. And let's say you wanted to buy a British company like, I don't know, Aviva. You put in Aviva, don't you? And say, I want to buy Aviva in my ISA, £1,000 worth. Well, instead of Aviva, you put in Microsoft. And they'll say, okay, there you go. Now, at this point, somebody goes, oh, but doesn't it cost £5 extra to buy a foreign stock? I don't want to make 10,000% return or whatever it is. You know, I don't want to make a 50% return because I've got to pay £5 extra. Or they'll say, what about currency risk? Have you looked at the currency differentials between US and sterling over the very long term? Sometimes it's up, sometimes it's down. And we're talking long term, 1 year, 2 years, 3 years, 4 years. You're not going to be going back and forth. You're not trading it every day. Remember, buying and holding, and I'll tell you for what time frames. So we want that bigger universe of stocks to pick from because I want the best of the best of the best. It's my son's inheritance, for God's sake. Now, I actually don't believe in inheritance, and the little bugger doesn't know this. He's not getting an inheritance. But anyway, it's my pension or my retirement or funds that I might be leaving in my will to charities. Okay, but it matters. It matters, right? So I said this to this student. I said, what the heck? What the hell are you going to do about this? And he goes, oh, well, I just read the newspapers. I see a headline and it says 3 stocks you must own now. And they usually write Lloyd's and National Grid because that's a good SEO. That's what editors are writing based on that. Okay. And I said, wait a minute. This is a bad way to pick. So how do we do it? And by the way, just so you know, these are some of the picks in my son's portfolio. Okay, just some of them. I'll come to the others later. Right now, I do happen to have an index tracker, but when it's an index like the S&P 500, I have it 3 times leveraged. Now, you might say, that's too risky, Alpesh. I'm not saying it's right for you. I'm saying it's right for my risk profile. So when it goes up $1, I make $3. If it goes down $1, I lose 3. You can see the higher risk, high risk. Don't do leverage. Just ignore my leverage comments. I'm just telling you what I happen to do. I don't want any of you doing leverage for the first time after watching my webinar because it needs a bit more education than that. And similarly with oil last year, we did it, and that's actually gone up more now. And I do it in what I call my quality stocks. And I'll come to that in a second, like Microsoft, Apple, Amazon. I have double leverage, but I'll come to some of these things in a second. I just want to show you the goals I'm aiming for. That's in my son's ISA, junior ISA, because he's only, 3 years old. All right. One other thing I've got to say to you, and I say this on all my webinars now, I'm going to teach you something. And hopefully from what I'm teaching you, you will remember in the future that when you make more than you need to live on, consider giving a little bit of it away. I don't want to sound like a virtue signaling idiot. I'm chairman of the Lombard Trust with Lord Billamoria. He happens to be the founder of Cobra Beer. He was one of the investors in my hedge fund, and he also happens to be chairman of the CBI. He and I are chairman of the Lombard Trust, which was set up by Lord Lombard. It supports widows and orphans. You don't have to pick that one. Pick UNICEF. Pick anything else. My point is they'll get a point, hopefully, when you've got enough for your family and its future. And the reason I say this is because when people do make a return, they go, oh, Alpesh, listen to what you say, I'm going to do it. And they've done it, and it works really well. Wherever they give it to, UNICEF is a good one. Save the Children's a great one. Please connect with me on LinkedIn as well. Okay, so let's get on with the webinar. And I'm going to give you knowledge from not just my experience as a fund manager, but also the whole universe, okay? A universe of the networks that I have. And I'm going to give you information from all my books. So you don't need to buy them. Okay, this is not a pitch for my books. I've written 18 over the last 23 years since the first one came out. You don't need to buy them because I'm going to give you the best bits. And even better, have you all downloaded a free copy of this, my book, Investing Unplugged, which was an international bestseller, I dare say, and great reviews. Have you all downloaded this? If you haven't, I'll make sure you all get a free download of that before the end of the webinar as well. And listen, this is not new for me. I've been doing this since my show on Bloomberg in 1999 all the way, and it's still Sally on the BBC. In 2020, it was all Zoom calls on BBC. It wasn't in studio last year. Okay, so I'm going to give you all of that. I'm also going to give you some of the insights from JP Morgan and UBS and everyone else. Now, my job's really simple. I have a very simple job, okay, for my family. And it is this. It's trying to convert every 10,000 into 3 million, right? That sounds easy, doesn't it? Well, actually, it's a bit more difficult than that, and it's not as easy as it sounds. You don't, and I don't just buy an Amazon or an Apple and buy and hold it forever. So all these idiots who say, oh yeah, if you bought Amazon 20 years ago, today it'll be worth this. If you bought Apple 20 years ago, well, who the hell does that? Because look at this. For years and years, it goes nowhere. These aren't great companies for ages. There are periods when they go up and there's periods when they just go sideways, when you don't want to be owning it. All right, so forget the people who say, oh, all you had to do was buy it years ago. The other point I want to make is this. I'll give you the download link for the book for everybody who hasn't downloaded it before the end of the webinar. So don't worry, I'll give you the download link. The other thing I want to say is this. It also means you don't buy and hold forever. Because what if you bought and hold and didn't pick an Amazon or an Apple and you picked a stock which stank and you said, right, I'm stuck with this for the rest of my life. So there's got to be a holding period, a review period. And I'll tell you what the Goldman Sachs research shows and my research shows that period should be. So let's just go to our financial goals for a second. Assume you plan to invest for 10 years. And with a bit of my help, and of course the market really, it's not me who gets the returns, it's the companies, it's Square or Tech Target or Trade Desk or whatever that generate returns, not me. I'm not doing anything, I'm passive, okay? Might be MedSpace. You might think, who the hell are they? Well, I'll tell you some of the stocks I may or may not like at the moment, right? It's them doing the hard work, not me. Okay, so I can't take credit for it. And you, with my help, let's say you make 20% per annum. Now, for my global picks, I want to make 40% per annum. And you might say, that's a bit ambitious. Have you looked at what the hell's going on with stock returns? 40% is not ambitious. If anything, it's probably a bit unambitious in the current environment, okay? It's not me doing it. It's the market. It's not like I'm some superhero. It's them working hard. They're cleverer than me at those various companies. All I did was put a bit of capital in their way. Great. You know, it's the easiest bloody thing you can do. I hit an enter key and took the credit for all the hard work that the companies I put the money in did, right? I'm a man. I'm bound to take credit for other people's work, aren't I? And with my help, let's say you make 20%. Some years you might make more, some you make less. So let's be a bit conservative. With my UK picks, I'd only expect to make 20% because the UK markets tend not to rise as much as the US ones. And let's make this other point. I'm British and very proud of it. I want British people to own global stocks. I want them to have Johnny Foreigner working for them, making them lots of money, and then repatriating that money into Britain and spending it at their local Aldi and Poundland and Sainsbury's and Harrods, okay, whatever your sort of particular place is. And the government does as well. That's why it allows in your SIPP and ISA foreign stocks, because it wants you to have a comfortable retirement, okay, in these tax-free savings. And the great news with this is the younger you are, and there's some 20-somethings in here as well, I know, watching this, the younger you are, the better and easier it is to make those returns. You can also plan, let's say we're doing this. Let's say you start with 100K, and you're going to say to me, Alpesh, we're not on 100K, okay? You're not in, we're not on 100K. Well, I'll do the smaller example later. So the 100K is probably somebody in their 40s, 50s, 60s, obviously. I'll do a 10K version, which is probably somebody in their 20s, maybe 30s, right, in just a second. And let's say you plan to add 1,500 each month. Divide everything by 10, by the way, if you've got less. Okay, well, you'll have 1 million in 10 years. So you go from 100K to 1 million in 10 years on that. Okay, what does it look like? It looks like this. The blue line is your contributions, because you're obviously going to add some. You're not just going to say, I'm never going to add to my savings ever again, right? And in 10 years, you go from there to there. Now, what's interesting about this? Well, first of all, it's taken 20% as an example, okay? And you'll see it accelerates as time progresses. So the really juicy part is really years 6, 7, 8, 9, and 10. These early years seem a bit slow. They're the years where you're tempted to take your money out and say, oh, it's not really doing anything. Darling, let's go on a holiday instead, right? Actually, that's where they have the impact at the back end, right? Then it just starts getting crazy, right? Well, let's say you don't have those numbers. Let's assume you only have 10K to start with and plan to add 6K a year. Maybe you'll put 500 in a month. Then this is what your return looks like. And let's say because you only started with 10K, you're going to take longer over it. You're going to look at 15 years, okay? Well, and this is what my son's looks like, because his is in an ISA, so he starts off with less money because the ISA maximum is smaller. It was 4K when he was born, and I think last year it was nearly 10K. And so he's about here. And you might think, well, it's not much more than the contributions you've made, Alpesh. Not great. Yeah, because by the time he goes to university, the spoilt little brat will probably have about $500,000 or pounds, because you can convert this into pounds. It's, you know, the maths is still the same. £500,000. Well, I wouldn't have minded that. I didn't grow up with a silver spoon when I went to university. I had to be on a full grant. I grew up in, I'm born and raised in Leeds. So the biggest worry I want to have when my son goes to university is to make sure the brat isn't spoiled. He's a lovely kid. He won't be spoiled because I'm a Yorkshireman. He definitely won't be spoiled. But my point is, right, how do we do that then? Now we know what the goal is. Tell us, show us the names, show us the stocks, right? Part one, problems investing now, which will take me 5 minutes. And then part two, let's look at the stocks. What are the solutions to our problems about investing? Which are the stocks I like, Goldman's likes, Buffett likes, the names, and how do we pick them? All right. Now, here we go. Let's look them over. What are these great stocks? First of all, problem number one, there's too much information. So we're going to remove it. We're going to simplify it. Of course, we all know there's a multitude of ways to value a company. There's price to earnings growth, price to book, price to sales, discount cash flow. How the hell are we supposed to value it? Which one of those do we pick? Which one of those do we know is important? Which one isn't important? And the value of a company, i.e. its share price relative to the cash it generates, or the value of its assets, or how much its profits are, or how quickly its profits grow. Those are all different valuation factors. Surely somebody's done some analysis somewhere which tells us some things are more important than others. But wait a minute, don't overvalued companies still keep growing, and don't undervalued companies sometimes go bust? So valuation can't be the only metric, can it? No. We know growth in terms of sales of a company, or earnings, which means profits, or even cash flow, which is not even profits, it's just cash. Is that important? How important is that? Which one of these factors is important? Thankfully, there's been ample research done on this. What about dividends? We know companies which pay dividends tend to, as a general rule, there are exceptions, as a general rule, do better than companies which don't. But is that the only factor we should look at? Of course not. We also know some companies just run on momentum, just the trend alone, noise. But we also know that if we follow that, we're going to get wrong-footed and fall off a cliff. So how much weight do we give to each of these factors? And what about the fact that all stocks are they're just share prices? If they're prices, why don't we just look at the distribution of those share prices? If something just consistently goes up every single month and every single year, why don't we just back that? Who the hell cares about its earnings, its growth, its income? You just look at its share price. It just keeps going up every single month. Let's just ride that distribution. That's statistics. How important is that? And what I'm going to suggest to you, and based on my research and what I'm going to show you from what I've written in all my books and in my Financial Times columns. Don't forget, everything that I'm saying to you has been published in my Financial Times columns as well, is this. We have a strategy and we have tactics, and this is why people don't make money. They get these two mixed up. And I'm going to show you what the strategy should be, and then you can pick whatever tactics you want. Strategy is, yes, we're going to look at valuation, growth, income, cash flow, outperformance of a company, and the volatility of its share price. We want volatility to be low and we want our performance to be high. We want cash flow to be high, dividends to be high, revenue growth to be high, and valuation to be low. Why? Because we don't want to be gambling on, oh, the market now wants growth companies. Now it wants momentum companies. Now it wants undervalued companies. We're not gambling on that. We're not gambling on news. Why? Because that's higher risk. We don't want to be speculators. Let 90% of everybody else do that, because we have got our eye on the prize. We want our 40% per annum, or 20% if we're only looking at UK stocks. There's no reason to do that. But even if you missed your 40% and only got 20, you saw you were still getting rich over a period of time and you were sleeping easy. Okay, so we want to tick all of these. As long as the stocks hit our strategy, I don't care what tactics within there you might use. Now, the tactics you might use is you might say, well, I want some smaller cap companies. By the way, at the moment, tactically, I do want some smaller cap companies, because within this overall strategy, I believe the smaller cap companies, like the Russell 2000 companies, will do better. But that's tactical within this strategy. It has to be within this strategy. I might say I don't want to be too heavily loaded on NASDAQ companies because they did so well last year. There's going to be a shed load of profit taking. So I want companies from other sectors. That's tactical within the strategy that they've still got to meet my value, growth, income, cash flow, outperformance, volatility factors. I filter. It's a bit like interviewing candidates. They've got to have won the Nobel Peace Prize. They've got to have got a PhD from Oxford University. They've got to have a track record of just being amazing everywhere they go. Great references. Now, within that, if they've got blue shoes or black shoes, I don't really care. What color, whether they're male or female, so I can level up the numbers. Yeah. Tactically, I might say we need a woman now because we've got too many men. We need an ethnic minority because we're disproportionately underrepresented. But that's a tactic within the strategy. They've still got to be meritable and be within the overall strategy. So we're going to look at strategy in a second. Geography. I do want more UK companies this year because I think we're lagging. But out of my stock, I'd probably say only about 15% are going to be UK. For instance, I own CMC Markets. Volatility. I might want slightly higher volatile companies within the overall strategy because I want to take more risk, but that's my risk appetite. I might want some of the big gurus, and I'll come to that in a second, and the analysts at the banks quite like, or fit the news. Well, that's just nice to have, but that's tactical. Within the strategy, it's got to sit. I.e., do they tick all these boxes? And then if the news is nice, great. The mistake most people make is they start with the tactics and then they try and find a company. So they go, what's in the news? Oh, I'll buy this company. They haven't looked at the valuation, the growth, the income, the cash flow, the outperformance, or the volatility. And then they wonder why it falls like a dog. Okay. You and I know market's going to do two things. They can either go up or they go down. We want the kind of stocks which when the market goes down, ours don't fall as far. When the markets go up, they go up further. Right? What you might call square root companies. Remember what a square root looks like? Okay. We want companies which don't fall as far when the market falls and rise more when it rises. Well, what kind of characteristics do you think those kind of companies have? Do you think they have relatively good valuations to their profits? You better bet. Good growth. Yeah. Income, cash flow, outperformance. It's the fact that it's not about how much money you make when the market's going up. It's how much you get to keep when the markets are falling. And we want the kind of companies which when the markets fall, don't fall as much because they've got that cushion of outperformance, cash flow, income, growth, value, right? Beyond that, tactics, I don't care what sectors you pick and so on. Okay. So like I said, the secret to success in the markets, I'll name some more names in a second and how you find them as well, but I'm giving you the theory of it to get you into a level of expertise. Companies which fall the least in down markets and rebound the most in rising markets. Everyone is a genius in rising markets, all right? Everyone's a genius, including me. We're all geniuses. It's not how much you make, it's how much you get to keep when the market falls. Companies which fit the above a few, approximately 10%, they're strong on profit growth, dividends, cash flow, consistent sales growth, fair valuation, and outperformance. And it's not me who's just making this up. In actual fact, the people who advise the wealthiest, richest people on the planet, this is stolen from Goldman Sachs. Guess what they do? Oh, we look at management quality, sustainable leaders, industry positioning. They're just saying exactly what I've said. And we look at return on capital and this formula. Croaky, I'm going to come to that because I've stolen that from them. And that generates 30% per annum. And I'll show you their slides. So you don't have to take my word for it. Their slides on that. And everything I'm telling you, I've published in my columns and in my books, just so you know that. All right. I don't want you to think, oh, well, he's just pulling this out of the air. Not only that, all of it has been monitored and regulated and all the rest of it by Financial Times award-winning companies, independent of me. And they've been doing it since 2004 when I'd been offering it and giving the data to them. All right, in terms of my picks and what my ideas are. So I've been double, triple, quadruple probed, as it were. All right. And I don't have a problem sharing it all, let alone the fact that I'll talk about it on. Now, I've been accused of being full of myself. I'm not trying to be full of myself. I'm all right. What I'm trying to be is to make sure you know that it's been vetted, and you should know anything. What anybody says on the internet is vetted. So please don't confuse my evidence to show credentials as being full of myself, as somebody once said, right? So let's get to it. What are these strategies from these various sources and places? Now, the first thing I want to say to you is this. On the whole, by having stocks, this is your portfolio risk, okay? This is your portfolio risk. This is your market risk. You can't diversify away market risk. What I mean by that is when the market falls, everything falls. Costco and Microsoft fall together. Okay, Microsoft does fall. It doesn't just keep going up. This time last year, it fell about 25%, and that's probably the safest company I can think of. You might be able to think of safer companies than Microsoft, but I can't, okay? So my point is this. I think once you've got about 15 to 20 stocks, you've pretty much diversified most of market risk. So all those people who want to defend fund managers for having 100 companies and putting a tiny bit of your capital into their 98th company because they get broker kickbacks, you go ahead and defend them all you want. There is nothing I can say to persuade you otherwise. You go and be an apologist for fund managers pissing away your pension fund, okay, on their boats and yachts. Go ahead. But all I'll tell you is if you're picking your own, you might want to look at 15 to 20 picks. If you're really worried, maybe 30. I'd probably say, don't take my word for it. Just look at the data on it once you get past 40. And you might say, no, Alpesh, this is wrong. What if they're all in the same sector? Well, data shows that companies on the downside are highly correlated regardless of sector. When the markets fall, when we need diversification the most, we don't get it. We don't get it across geographies or sectors or market cap. Yeah, when the markets fall, Chinese companies fall just like British and American ones do. When the markets fall, retail companies fall at the same time as software companies do, I'm afraid. And the data shows it. I wish it didn't, because it'd be easy then to make money. I just have a bit from everywhere and be well diversified, right? Now I can send you the data if you really want to know and get a PhD in the subject. Okay, so for me, the markets can do one of two things. They either go up or they go down. So I've got my 15 to 20 companies. Now I have 5 companies which I consider quality companies, and I review those every 12 months. And then I've got the rest which are performance companies, which I review every 12 months as well. I'll tell you what my 5 quality companies are in a second. By quality, what I mean is if the world comes to an end, they're the ones where there'll be a flight to quality. They have got so much cash in the bank and yet they grow that they still give me upside returns, and if the market falls, I still get a good night's sleep because they won't fall as far and they'll rebound more. That's my 5 quality companies. The rest are performance. All are reviewed after 12 months, okay? So I don't buy and hold everything forever, and I'll tell you why 12 months in a second. Equally, if the market falls, well, my quality companies I still hold, but with my performance stocks, if they drop 25% from the highest they've been since I bought them, within that 12 months, I exit. And if 12 months are up, then it's time to review anyway. Why 12 months? Let me share that with you. Now, whilst I might get data, because obviously as a hedge fund manager, guess what? Goldman Sachs, UBS, they all send me lots and lots of information because they want us to trade through them or give them capital and all the rest of it. Or they want us to do what they're doing so that it becomes a self-fulfilling prophecy. March the 26th, 2020, they sent an update on coronavirus. That was pretty much the bottom of the market. And Goldman Sachs had pretty much said, we're going to start buying. Now, I'm not gambling on what they say. I'm not gambling on any inside information. Don't have it. It'd be illegal anyway. It is something which goes into the pot. I still have to look at the strategy, value, growth, income, cash flow, momentum, okay? Outperformance, all of those things. And I'll explain how we get those in a second, Maz, my friend, in a second. The other problem you've got, so we're going to do problems first, then we'll do the solutions, is your fund manager, right? And this is the problem with your fund manager. I want you to look at what you've got in your SIPP and ISA or your savings and your desire to give it to a fund. And they have to give you what's called a key information document. I want you to drill down on that. And I want you to look at why the hell have they got over the last 3 years. This is a typical fund one of my students had. Okay, 91 UK, listed equity growth. Listed equity growth fund, down 2.3%. Down 2.3%. They've got 8 out of 10. They've got all these diamonds. They've got a letter A. It's all marketing bullshit, I'm afraid. Okay, all of these, okay, have got, these are marketing gimmicks. How are they marketing gimmicks? Because over the last 3 years, he's down 2%, and the US stock market is hitting all-time highs. Well, of course, because he's only invested in UK equity growth. Why? Why are you picking from a narrow gene pool? I mean, that's just racism. Okay, and it's fashionable to call everything racism, but you're just saying, I'm only going to pick UK companies. What the hell's wrong with you? Why would you do that to yourself? Why would you not say, I want the most talented people in the world generating a return for me? And this is taken from that fund manager. Pick any fund, and this is what they'll tell you. Moderate scenario, what you might get back after costs. Average return per year, let's say you get 5%. what you'll get back after cost will be roughly about that average return per year. That's what they're telling you. After cost, we'll give you back 5% per year, barely more than a high-paying bank account. 5% per year, get lost. You know why? Because the fat fund manager's getting the rest. Okay, top holdings. Let's look at their top holdings. This is why I'm telling you to do it. And by the way, those of you who say, no, what about passive ETFs? What the heck do you think passive ETFs are investing? They're just fund managers without the fund manager. They're still doing the same investments. They just got rid of the fund manager and got a computer instead. Same investments. Okay, so here you've still got the same problem. The fees are lower. That's all. Top holdings. BP. This is before the oil price crash. This. All right. Shell, before the oil price crash, called it a UK growth fund and put it in tobacco. Look, excuse me, but I didn't realize tobacco was a growth industry. I thought people are smoking less than ever, right? 48 stocks, and they're all in the largest UK companies. No wonder he's down 3%. That's your pension. That is a typical fund in a typical pension. Look at your own, go ask, or look at the fund you're looking to invest. They've got to give you that document. When you look at it, you'll think to yourself, oh my God, what the hell? Why the heck have I given them that money? Okay. And here's worse. Here's the kicker. For all of you who think, yeah, but Alpesh, they only charge 0.5% per annum. No, you've been lied to. Look, this is their own document. Investment, £10,000 scenarios. If you cash in after 5 years, recommended holding period, £1,000. Total cost, £1,000, 10%. But Alpesh, it said 0.5%. I'm sure somewhere I read 0.5%. Look at their entry charges. Look at their exit charges. Look at the total cost of ownership, the compliance charges, all the other charges, the brokerage charge. Look at everything, right? All the small print. Now, I used to be a barrister, so I'm used to looking at small bloody print. That's their figures, 10%. Every 5 years, you're giving away 10% of your capital to the fund manager. No wonder everybody's dying to be a fund manager. No bloody wonder. Jasminder's asked, can you hold a SIPP and ISA at the same time in the same tax year? Yes, Jasminder. My friend, we better speak. You're worrying me. Because if you don't know that, then you've been missing out on great tax-free returns, or at least tax-mitigated returns. And it worries me. It's not your fault, my friend. Nobody teaches you this at school. Nobody tells you can have all these global stocks to choose from in your ISA and your SIPP, and you can have a SIPP and ISA at the same time, and you can use the same broker to do it. Nobody ever tells you this. Why don't they tell you? Because they don't want you to be informed, because they want you to go to, guess what? A fund manager. Because the fund manager wants to make the bloody money. And I can tell you can be better than a fund manager for this reason. So I'm going to tell you what I'm going to do. I'm going to show you the stocks that I like, how you should be doing it. Okay. All right. This is Neil Woodford. Now, I trounced on him in 2004. I know some of you will have seen this before. The Financial Times said, Alpesh, you've got a big mouth. You're full of yourself. Why don't you go in a competition against people like Neil Woodford and see you over a 12-month period who outperforms? And I said, I'll do that. You just make sure you put my face on the front cover of the Financial Times business section, and you proclaim me the winner when I win. And that's what happened. Now, you might think, you sound arrogant, Alpesh. Listen, I don't believe in being shy when idiots like this are ripping you off of billions, right? You could see it to the pensioners who've lost money with him. Why have they lost it? Because these guys market well. They market bloody well, right? If you want to keep giving money to them and making apologies, go ahead, be my guest, right? I'm not going to bloody do it. And if you think I'm Johnny come lately, that's 1999. That's my very first column in the Financial Times, September the 11th, 1999. And I said it then. So I'm not just making this up in hindsight. What's more, they should probably sell up their entire UK holdings and buy only US stocks. And I'm not just saying, oh, just go and buy US stocks. No, there's a lot of rubbish US stocks. You've got to pick the right ones. But you look at the US index, the Dow or the S&P since 1999, and you look at the UK. Well, I'll save you looking at the UK. It's exactly the same level it was when I wrote this article. It's exactly the same level. And that's where your pension's stuck, exactly the same level. And that annoys me because nobody's teaching you how to do it better. They're saying, give the money to fat cats instead, okay? All right. I've got a few people saying, oh, my broker doesn't allow me to. Have a look at Hargreaves Lansdown. Have a look at AJ Bell. Have a look at Free Trade. There's loads of UK FCA regulated brokers who will let you. All right. There's loads of them that'll let you. All right. So there's not an issue there. Problem for when to sell? It's not a problem. It's not a problem at all. I've just told you. 12 weeks, or if the market if your stock falls 25% from the highest it's been. Harper, shouldn't there be more complicated rules than that? You can if you want, but don't make it more complicated. One of the reasons is this chart from Goldman Sachs. Basically, what this is saying is 12 months is a pretty good period to be holding equities. It's the period over which the fundamentals apply. Now, we can argue the toss later on, but we haven't got the time. 12 months is what we should really have. Interactive Investor, Sean said. Sean, I owe some emails. Thank you, my friend. You've just reminded me. Yes, Interactive Investor will allow you to do it in your SIPP and ISA as well. I'm not going to endorse any particular broker other than to say, just be careful of the ones who charge a percentage of your assets under management. Like Hargreaves will charge 0.45% of your assets under management. Okay, so if you've got 100K, they're going to charge 450 quid, which you might think is not too bad, but if you've got $1 million, it's 4.5 grand. Okay, whereas others, like say a free trade, and I think an interactive investor will only charge, say, £3 a month. So you make some savings there as well. Mark says, what about tax on US shares in an ISA when they would be no, Mark, again, that's the amount of people making stuff up because they don't know better, Mark. There is no tax on US shares any different to what there would be on UK shares. This absolute nonsense that on UK shares there'd be no tax, but on US there would. Where the hell did you make that up from, my friend? No, it's wrong. Okay. Narendra, I know confidence comes across as arrogance. So Mark, thank you for asking me. And by the way, thank you for raising that point, because sometimes I don't know the misinformation people have. Ramesh has said, can I sell my holdings in funds held in a SIPP and buy individual stocks? Yeah, you can do anything in a SIPP, in and out, because it's all within tax-free wrapper as well. Anil said 50% is taxed on US share gains. Since when? Since when? Okay, so here we go. There we go. We got all of that, right? Now, what are my strategies? Now, I said strategically, I have got, okay, strategically, I've got value, growth, income, momentum. Now, within that, I may well look at sub-strategies like what do the gurus hold, right? What does, for instance, what are the top holdings of Bill Ackman or Bill Gates or George Soros or Warren Buffett? Warren Buffett with 228 billion and 49 stocks. What stocks do they hold? That doesn't mean I go out and buy it, okay? Doesn't mean that I go out and buy it, all right? It doesn't mean I go out and buy it. All that happens is it still needs to be my value, growth, income. So I do own Fiserv. I do happen to own Apple, but not because they own it. So what I'm trying to show you here is the difference between tactics and strategy. Strategy is it fit my strategy of value, growth, income, right? Now this allows me, it's great because it allows me to be calm all the time. What it means is, Phil, the answer is yes. Just email me, my friend, and I'll do that, okay? What it means is that when somebody throws a name at me like, Alpesh, what should I do with, say, Amazon? Or did you know George Soros just bought, brought Danaher? Or Warren Buffett just bought this? I think to myself, so what? Does it still fit into my value, growth, income? Or if somebody says to me, these are the top stocks owned by hedge funds, okay? Fahim, great point, of course. ISAs and SIPs are capped in terms of how much you can put in each month. Okay, when somebody says to me, Alpesh, these are what the hedge funds have bought. Again, I don't care as long as it still hits all my criteria. So it allows me to have a good night's sleep, that I'm not chasing any particular. By the way, in this, just so you know, I didn't buy Etsy, but I wish I had. And Advanced Microsystems I didn't buy, but it was in my, I can't buy everything which ticks all my boxes. Only 10% of 9,000 stocks hit, I think not even 10%, I think 5% hit the things. What do I own at the moment from here? T. Rowe Price, still. And I'll come to some of the other names in a second. I don't have anything which is in the securities dropped hedge fund slide. Okay, so again, just because Warren Buffett has got this, and you might see these things come up on newspapers, and you know, websites are always mentioning these names because they want you to read and subscribe and all that nonsense. Doesn't matter. Value, growth, income, cash flow. And I'll come to all of those factors. So whilst my team might give me this data, I don't care as long as it fit mine. When I look at this and I think, ooh, you know what, Apple, fine. I'm still in there, so it hits. Now, if we do that at an aggregate level with all the big gurus, so what would happen if you took a Buffett, a Soros, Renaissance Technologies, all of those together? Well, dark green out of the S&P 500, dark green would be the ones with the most interest, and that's United Healthcare, by the way, okay, which I own. Hasn't done great things, but it's okay. It's a safe haven. Amazon up there. Viacom, I'm going to come to in a second because that was one of our picks from this time last year. So you'll see what we did. The great thing is we're in March, so I can show you what was picked from the webinar exactly a year ago. Some of you, Fahim and etc., will have been on anyway. And then lighter green to the ones at the bottom, right? Now, it doesn't mean I go and buy it on that. That could be a strategy. It's not going to be mine. Mine's going to be valuation growth income. But this would be a nice to have if it's in the top part, okay? Equally, I leverage big on low risk. That's because I'm more risk loving. What does that mean? Well, I pick stocks which are lower risk in my view. My quality stocks being Amazon, Alphabet, Microsoft, Facebook, and Apple, and I do 2 times leverage very often, or in the case of the S&P 500, 3 times. Don't do this, you guys, because I don't know who you are, and I don't want you to do any leverage, okay, without understanding it fully, and I'm not going to explain leverage in detail in this webinar, so don't do leverage, please, if you're listening to this, but I'm just telling you what I do, okay, on that part, and leverage we can do a separate thing about. Investment strategy 3, what banks are telling their richest clients. Again, it still has to be value, growth, income, okay, value, growth, income. Rajesh, just email me because I won't necessarily be able to. I'll try and come back to it in a second. I know, my friend. Thank you so much. You know what? There's so many people who've said that to me. There's so many who have. I'm going to broadcast that comment to the room who have said exactly the same, my friend. But email me if you want more pointers. So you may know from last April, and some of you were on the webinar last April, I looked at Citigroup. And because it had our value, growth, income, cash flow, everything else, I looked at what the analysts in the red line were saying. On average, they were saying a price target of 78. Now, analysts are always optimistic. And in April last year, I said it could go from where it was, 42. Look, it was 42. There it is, 42. I said it would go to about 70. Well, today it's at 73%. So it's over a 50% return. Okay, which isn't bad in a year. It's above our 40%, what we want. Capri Holdings, you'll remember this from April last year, guys. 12, and I said, because it was at 12, look, April the 7th, there's the screenshot, 7:54 p.m. from the webinar. Capri, 12, it was at $12, and the analyst was saying about 30, and I said it could go to 30. Well, today it's at 56. So that's what, a 300% return? Help me with my maths. Is that a 300% return? Okay. After 100%, I get a bit rubbish. I got the maths prize at school and still can't do my percentages. In March last year, so this time last year, and you'll remember, who was I buying this for? My sister. All right, because you wanted it for her kids' school fees. And I said Disney. 99 back then, I said it could go to 144. Look, 99, 144. Well, today it's 194. So I'm her favorite brother because that's a 95% return. It's a 95% return. Okay. And there we go on that one. They haven't all done amazingly well. What Paresh? Tell me about Win. They haven't all done amazingly well. In March, I said can go from 27 to 43. Today it's at 56. That's 100% return. Great. Uber. Now, I didn't know. I wasn't speculating on people going to their cars or not. Okay. With Uber, it was value, growth, income, and what the analysts' forecasts were. But I didn't look at analyst forecasts alone because I would have messed it up. Analyst forecasts are always high. It had to still be within the strategy of value, growth, income, momentum. All right. Email, please, Miles, is better than LinkedIn. Viacom, in March, I said it could go from 12 to 37. Was I wrong? You know, there you go. 12 is what it was at on March the 30th, so almost a year ago. And I said $37. Was I wrong? Because today it's at $90. Somebody do the maths. What's that? 750% return? I might have got it might be 650% return. Okay, so I got it wrong. It did far better than I thought it would. It did far, far better than I thought it would. I had no idea, okay, on that. So I did that in the previous webinar. And then one more, March 242. This was United Healthcare, 320. It was at 242. I said 323 because that's what the analyst had said. Today it's at 356. It's pretty much the same, 50%. So it's not been great. That one by comparison hasn't. Now, we're not just going to look at analysts. You know what? We'll want to look at who the bloody hell was the analyst, which bank is he at, how recently did he give the target, how big is the target, right? Those are all, who else agrees with it, and what's their track record? So think about it. It's all of those things. But that's not going to be enough. I still need to know value, growth, income, cash flow. Always come back to that. Now, I don't expect you to do all that research. That's for me to do and look at and all of that. But what I'm just telling you is when you read something like an analyst has up this or done that, I want you to remember where that belongs in your head. It belongs with, yes, but does this fit? Valuation, growth, income, cash flow, alpha, all of those things, outperformance. All right. When somebody writes and says, and we look at this, there's a lot of hedge fund interest. Yes, that's tactical, nice to have, ticks a box, but does it fit into the strategy overall? Now, we happen to monitor all these hedge funds, but that doesn't mean we'll just buy the stock. I'm going to sound boring, like a broken record. You might say, too late, Alpesh, you already did. Okay. It's got to be value, growth, income, and all the rest of it, right? And just because Goldman's will say to us, Alpesh, this is what's going to happen. These are the big themes. And you can call up Peter Oppenheimer anytime you want. There's his email address if you want. Go bug him. Say, what do you think, Peter? Doesn't mean we're going to go buy into it, right? It's got to sit in. So the reason I'm telling you this is because you're going to come across the internet. People are going to say to you, these are the 12 entries. So Goldman Sachs list of 50 very important positions. This is their stuff for hedge funds. So what Goldman Sachs do each year, they create a VIP basket that's outperformed the S&P so much. Okay, it's got $1.8 trillion of gross equity exposure across 822 hedge funds. This is what they look at, and these are the names they came up with. That doesn't mean I'll just go out and buy them. Of these, by the way, yes, I own Adobe. You know, Citigroup I already mentioned. I own PayPal. Guess what? That took a bit of a profit-taking whack over the last couple of weeks. Doesn't matter. I can sit pretty. Yes, I own Alphabet, MasterCard, ServiceNow, United Health Group, Visa, Google. But what else out of this group do I own? That's it. So you notice there's some I didn't pick of theirs. Why? Well, if it doesn't hit mine, I don't care if they're Goldman Sachs. I don't care if they're all the biggest hedge funds in the world. I don't care. It's got to still hit my criteria as well. You might say, well, you're an idiot. Why don't you just do what they're doing and copy them? You may be right. I suspect I'm the one who's right. There's another factor which I think is incredibly important that I want you to focus on, and it's this. And I've stolen this from Goldman Sachs. Okay. And this was a slide which they presented to me about 10 years ago, and I've been stealing it and using it ever since. It's a formula which was created by Deutsche Bank Wealth Management, advising their wealthiest clients, and now Goldman Sachs Asset Management use it as well. And what they worked out is if you look at the cash flow of a company compared to its capital invested, something called the CROCI. All right, so this is why I keep talking about cash flow, but there's a specific variation of cash flow. They discovered you get a 30% per annum return if the company is in the top quartile. Now, this is really important. You don't get that every single year. The whole point of an average is that's an average, right? There are some years, look at this, when the financial markets crash, nobody got that. I didn't get 30% that year, all right? So I want you to understand this is not like a bank account that pays you 30% guaranteed every single year. With the market, the longer you do it, the more close you're going to get to the long-term average, right? It's a bit like tossing coins. Just because you throw 10 heads doesn't mean your coin is fixed. But if you do 100, you'll get closer to a half, right? Similarly, if you do this long enough, you'll get 30%. But 30% is not what I want. So the cash flow is not the only thing I look at. It's one of the things I look at. I want 40%. Okay, so I make sure my stocks are in the top quartile of that. Now, you're going to use different variations of cash flow to me, but I just want to show you that, and I cut to the chase and give you the source of my data. Personally, investing is like learning to drive. When you drive, you've got a steering wheel, rear view mirror, wing mirror. You've got brake, accelerator. Well, you've got, with investing, cash flow, valuation. All right, valuation, growth, income, cash flow, momentum, right? You've got Sortino, which is a measure of the average return versus the volatility. You've got alpha, which is outperformance of the market. All the factors I've talked about. Now, tactically within that, I might look at higher volatility because I want higher risk. I might look at companies from different sectors, but strategically it has to fit within that. That's my holy grail. Within all of that, okay. Oh, thank you, my friend Fahim. You've been phenomenal. I'm going to broadcast that comment to the room. Okay. One of the most, for me, the important factors are, like I told you, global in outlook, not racist to a particular country. I know that sounds funny, but it sort of gets the point across. Monitoring frequently. I'm not looking at this every day. I want to have a good night's sleep. They're investments. They're not trades. You never trade your investments. Otherwise, remember what happens? You mistime it. The market shoots up and you missed it. Now, look, I'll give you an example. I own PayPal. I suspect, and this is, I'm going to be incredibly honest with you. I own PayPal. I suspect it's going to fall. It is more likely to fall in the next month than rise. So you might say, why the hell do you own it then? Why don't you trade out of it? What's wrong with you, you idiot? And the reason for that is, guess what if it rises? Equally, I don't want to trade my investments. If I trade that one, I've got to trade all of them. And I'm holding it for 12 months and probably the next 12 months after that and the 12 months after that, I suspect. So I'm not going to try and worry over a week or even a month over that period. It's a bit like, let's say you own a house and somebody says to you, next month house prices are going to fall. Do you go and sell it and rent and then go back again and then go back and forth? No. Why don't you do it with a house? It's exactly the same reasons you don't do it with stock, okay? It's exactly the same reasons. Julian, I'll come to stocks in a second, my friend. It's a very good comment, and I'll come to, sorry, not stocks, cryptos in a second, right? Now, I developed all of this when I was at university, okay? And I'm going to answer all the questions in a second, and then won that competition. I wrote books because I thought that'll raise my profile to create a fund, which is what it did. You need profile to create a fund because fund management is... oops, I'm going to switch off my... I think my TikTok's already ended. Apologies to all the TikTokers. And Fahim, everyone else, you can sort of switch off. You know all of this stuff. People said to me, well, can you teach us this? And I said, yeah, I'll teach you all of this. I'll do free webinars. But a smaller group said, well, actually, no, we want one-to-one hand-holding. I said, I don't have the time. And a good friend of mine, Bikwala Walia from Barclays Bank, said, well, why don't you spin it out as a piece of software and mentoring with you to a limited number of people? And then if it works, you could get venture capital investment, disrupt the financial fund management industry, the multi-trillion-dollar fund management industry, by empowering other people to invest through software that you provide them. Make sure you don't charge them subscriptions each day, each week, each month, so they don't have to keep paying for the rest of their lives because you're trying to get away and disrupt that whole model, but equally give them access to an individual. So you've got that blended model of software and human. And I thought, no. And then he said, wait a minute, let's do some numbers. If you get venture capital investment into that and make it global, this could be $1 billion business. That's when I said yes. So we spun it out of the hedge fund. We created different pieces of software and access to third-party software, always free, free as in included in the whole thing. And we did that. We put it together for things like the Dow, the S&P and everything else. Now, of course, from everything that I've told you, you could try and reverse engineer it, and you're more than welcome to. You can follow me on my free Telegram channel as well. This is really platinum for those who want the one-to-one, okay? But whatever you decide, remember, it's value, growth, income, momentum, cash flow, outperformance of the market, volatility as well. It's all of those factors, factors as well, okay? Really critical. And we realize we don't have a competitor in this space because there's the trillion-dollar fund management industry, and there might be little bits of software which don't tell you anything, or websites, journalist content. Well, that's no good. Software's no good without a brain behind it and the hand-holding that people want. So we thought, you know what, we've got to do the ed tech bit, the educational technology behind it. And that's what I did. I launched that behind it to make it easier for those who wanted that that one-to-one part. And then I talk about it on the news and all the rest of it, the mission to make sure more people are empowered. And that's why I do free webinars. I've got a free Telegram channel. By the way, if you want to download the book, that's alpeshpatel.com. Just go there, and you'll be able to download it and download on my free Telegram channel as well. But because we had some great, continue to have great reviews of all of this, it occurred to me we should spin this out and offer it as a service. So software as a service, but no subscription charges each day, each week, each month. So if you've liked what you've heard and you want to be part of that, and my plan is in a couple of years to get venture capital investment into it, and then in a couple of years after that, float it on the stock market. It's as simple as that, because I think this can disrupt the entire market together with basically when you combine software, different pieces of software, and education and access to the fund manager and one-to-one mentoring and one-to-one education, so that you can educate people on what they've got in their SIPPs and ISAs and what they might want to have given what their knowledge is. So if you want to be part of all that, and I'll show you what we do, what I did is to put that together. I created this and said, well, what do people want? So we asked a whole bunch of people, and we try to give them everything they wanted. In fact, we did give them everything they wanted. Everything from access to 9,000 of those equities and one-to-one calls with me and course material to go through it. Because we think you can't just leave people. Equally, you got to get rid of the fund managers because they're underperforming. Nobody cares about your money as much as you care about it. No one cares about it as much as you care about it. And when you can teach people over a couple of 1-hour calls and get them up to that expert level, and then they've got confidence and they go, wow, okay, I know what I'm doing. But equally, they can call you anytime and say, right, okay, what's going on? That's like unheard of. Thank you, Sean, very much indeed. It is unheard of. It's unheard of. Okay. And so that's what I started offering and then started updating it. So for those who wanted daily updates, there was the Telegram updates. Just generally, they want to know what's happening with the markets. Others said, no. Once a month's fine, Alpesh. Just give us a monthly newsletter. But send us, BlackRock updates or Forex. You don't have to read any of this. You don't have to read any of this. This is there. So if you want deeper understanding, because it's not enough just to say to somebody, hey, take my word for it, cash flows. No, people want to know, okay, Alpesh, show me the research on it. What's your evidence for it? Not just that you've written about it. Show me the Goldman Sachs slides on it. Okay, show me why that's important. Let me reverse engineer it and do it for myself. Or others will say, I'm time poor, cash rich. You just educate me in one-to-one tutorials like you have at university. So anyway, Ravi, Fahim, you're all on board. Sean, you're on board. So many of you are on board with this. And it's a good reminder to you guys as well of what the original vision with all of this has been. So if anybody wants to come on, what I do with the webinars, and I do them about once a month or once every 2 months, is this. I give a 50% discount, limit it to 10 people because I'm doing the one-to-one mentoring and the handholding. In future, when it is global, there'll be other people to do the mentoring. You guys will always have me because you're part of the original cohort. And I do them in batches of 10. You've got me for life, of course, but it's in batches of 10. And like I said, because I don't believe in subscription fees, neither the softwares that we give you and the data and the updates, none of those you're paying for ever again. It's not daily, weekly, monthly, nothing. It's one-off, so you know where you stand with it. You know where you stand with it. And I include all of this stuff. And I remember, Fahim, you asking me, you said, well, how can we see what's in your portfolio? Literally, because it's on Telegram, or like I've done on this webinar, said this is what's in it on my portfolio at any given time, what I like. But remember, just because it's in my portfolio doesn't mean you should buy it today. And that was the point I think, Fahim, I made with you ages ago. What should be in yours today would vary because the markets change today. I might be holding mine with 100% return from the last 9 months. So we've got to look at yours today and get you educated, okay, on that. And that's what we do with that. And this is 12-month holding. Remember, this is not trading. Trading's different. Trading I'll discuss on Friday. This is investing for 12 months, okay, buy and hold. My most successful investment manager person I've trained up, Naomi. She left university, read English literature, joined me as my assistant, worked for me for 3 years, and then joined Newton. Today, she manages 10 billion with a B pounds as an investment manager. So that's my most successful success story. And I copied other billionaires. These two, for instance, who have apprentices. And the idea is you'll become my apprentice. And that's all the benefits of it. So if you do want to sign up, that's the benefits. Lifetime updates added, value to your portfolio over 10 years, access to Goldman Sachs reports. When I get these reports, I share them with you. You don't have to read them. I'll explain them and tell you what's important, what isn't. But most importantly, you'll see what I'm seeing, and we'll do the one-to-one calls. Because I got that idea from my university. We used to have one-to-one tutorials, and I thought, hang on, why should people be shortchanged? Why should they be shortchanged from one-to-one? It's only fair they have it. Okay, that's where you go if you want to join up. There's installments as well. We started doing installments just because some people said, Alpesh, I want to make the money over a period of time. So if you go there, there's installments as well. The idea is to float this eventually to really disrupt this market. Remember what I've said: value, growth, income, cash flow, outperformance of the market, lower volatility to the downside, higher average returns. Now, the technical terms for some of those things are alpha, Sortino, and Croakey. That's more technical, but the principles are what are important. The principles that I've told you, you're looking at the global market. That's what's important. I want people, like I said, I only do this once every month or every 2 months. The last one I think was January that I did. Okay. So thanks, Maz. No, I understand. That's why I said it. Oh yeah, Maz. Just send me the email. I've got your email, so I'll email you or just email me. No worries at all, my friend. Now, tell me exactly, Sean. Exactly, I like that. Now, tell me any questions I've not yet answered. Somebody asked crypto. My view with crypto. So I've got a, oh, by the way, there's a 7-day no risk money back guarantee. In those 7 days, we'll have 2 calls. One is to go over your existing portfolio. Then secondly is to look at where you want it to get to and the stocks from this list. So within those 7 days, and we've never had anybody within those 7 days say, I'd like my money back, please, on the investment program ever. Okay. And we have had every single person who's been on for at least 3 months, every single one of them will recoup their money back, their original cost. So everything else for the rest of their lives is free, basically. They've recouped their initial capital. Can't get the link for the book. I'll send you the link here for the book. It's just myname.com. It's as simple as that. The link for the book is just myname.com. Okay, should work. If for any reason it doesn't, let me know. But it's just myname.com. As simple as that. Yeah, thank you, Robert. Yeah, I want to give you did, Robert. You did indeed get an amazing deal. I hope you're happy. The idea with this cryptos. So one of the investors in my hedge fund is a chap who founded New Look, you know, the high street retail chain. And he asked me about 3 weeks ago, what's your view on crypto? And I said, look, it's a FOMO trade. In other words, a fear of missing out trade. Oh, I'll tell you some other stocks I own outside of my normal strategies. And I said, so Ethereum and Ripple, which I own, are FOMO trades. Basically, I don't want to miss out, so I put risk capital into it. But do I think it's going to go up 100-fold in 10 years or be down to 0? I don't know. I don't care because it's a FOMO trade, fear of missing out. I've also bought into, and I don't normally do IPOs because there's not enough market information. I bought into Roblox, fear of missing out trade. Not my normal trade, not my normal trade. So I share the outside trades with you as well. Bumble, IPO company. Why? Because I liked it. I like the founder. SPACs. If you know what SPACs are, Fisker and Tontine. Why? I don't normally do SPACs. It's not the normal strategy. So caveats there. Fisker, because the founder, who's now a billionaire, thanks to that, is an old friend of mine. CMC I bought, which it did fit into this, and the founder is an old friend of mine and a billionaire. It's amazing how as you get older, your friends become billionaires. Now, I grew up in a small poor town called Armley, and I went to a state school until I was about 13, and I could tell you I never thought I'd be surrounded by so many buggers who become billionaires. They make it look so bloody easy. Anyway, so I bought into theirs as well. So CMC was my normal way and it fit in because of cash flow and so and so. Fisker was because of that. Tontine because it's Bill Ackman. He's a great hedge fund manager, and I don't know him personally, but that was the SPAC there. So that's some of those. Jitesh, yeah, absolutely. It's very much for beginners. I would say 50% of the people I have on the program have never, ever invested before. 50% have never invested before. And and normally what they say is, I'm a pharmacist, I'm a doctor, I'm a lawyer. In other words, I'm cash rich, time poor, I'm a dentist. I don't know what to do. Can you educate me? And I educate them, but I educate them one-to-one. The education they never got at school, one-to-one, or at university, one-to-one. Installments are really simple. They work exactly the same way. You go to that website. You go to that same website that you see on screen. And if you, let me just show you the page. Let me just show you the page. Here's the page. Oh, and you get immediate access. By the way, if you go to that page, I'll just show it now. You get immediate access even if you're doing installments. I don't mind which way you do it. So if you go to alpeshpatel.com/shares2, for instance, you still get the discount. The discount's embedded, so it's still the same 50% discount, which I only do on the webinars. You'll see it there, 4 installments. There you go, and you can see the discount applied. Doom. and then you see the payment. There's VAT if you happen to be in the United Kingdom. If you're outside the United Kingdom, there isn't. We issue VAT invoices if you've got a company, and that's relevant to you. Coinbase, John, I've not looked into it, so I can't answer whether or not I'd buy it. Probably, I don't know. I don't know, John. I don't know. I'd have to look into it. If I do, I'll put it into my Telegram channel, but it would be a FOMO trade if I do. It would end up being a FOMO trade if I do. Okay. Do the same principles apply to cryptos and stocks? No, just mean the cryptos are completely different. Like I just explained, they're total FOMO trade, fear of missing out trade, total fear of missing out trade. Okay, that's the thing with that one. Oh, by the way, you can use PayPal as well, in case anybody's interested. I want to thank. Oops. There's a whole. Oops, let's just reset that one. One of the other things I want to get across to people is there is no ongoing charge. So everything gets updated. We've got a team who does all the work and the updating at the back end, but you'll always be talking to me. You'll always be talking to me. Kay said, what are the, right now, I'd have to look at your own risk profile. So it really depends on your personal risk profile of what would be suitable right now, because what I hold from 6 months ago or 9 months ago, would I buy it today? Probably not, because the market's moved on. I still would have my quality stocks. I don't have a problem with that. Haji, thank you very much for our webinar, Alpesh. Just wanted to know, I did my research, but it's better to start with a few stocks and then gradually build to 15. Oh, now this is great. Great question. You're worried about buying when the stock market's at a high. So if you are, think of a scale of risk averse to risk loving. If you're totally risk averse, you'd have a bank account, obviously. If you're worried the market's quite toppy, you might what's called pound cost average. You might say, well, you know what? I want to put £10,000 for argument's sake into Microsoft, but I'll put 3,000 in this month, 3,000 the month after, and 3,000 the month after that. That's called pound cost averaging. And the reason for that is you've got 1 foot in the market, 1 foot out of it. Okay, it's as simple as that. That's why you would do it that way around. Okay. But if you're like me, you'd say, I know it's toppy. It's like buying a house. Look, over 12 months and then over the next 20 years of my life, is it going to make a difference that, look, if we hit a recession, house prices double in 5 years. If we don't, in the good old days, if we don't hit a recession, they double in 3 years. So if the market is toppy and we've got in and then it drops, well, guess what? It'll take a bit longer to make our returns. So I don't try and time it in case I miss some of the big gains. And the reason for that is just look at what happened this time last year. Everybody said the market's just going to collapse and collapse and collapse. And what happened? It sharply rebounded. And I've got a whole bunch of people who had missed those rises. Would you class FAM as quality stocks? And no, the only ones I class as quality are the ones that I mentioned. Fahim, for those watching and not part of the program, thank you. Thank you, my friend. I will broadcast that comment. By the way, we've got an increasing number of phenomenal great reviews, and we've put them up here on alpeshpatelreviews.com, alpeshpatelreviews.com. They're videos and they're also case studies which are coming up. There you go, Fame, my friend. Plus, of course, I am fortunate enough to work with the likes of, well, Rothschilds are the banker. I should declare an interest. Rothschilds, they're the bankers to my fund. And so that's why they'd asked me to speak to all of their people. So I love all Rothschilds conspiracy theories. You know, when people go, oh, Rothschilds, they're the secret. I go, yeah, I think you're right. Here's me speaking at one of their events to their wealthiest people. It's people like me who tell them what they should be doing. So I love Rothschilds conspiracy theories. You'd like to invest in Square. I'm not sure I'd do it right now because I've got to look at Square. I've not looked at that one. I've looked at the one. I've told you what I currently own. I can't tell you what you should buy for obvious reasons. I don't know your personal, we'd have to talk about your risk reward profiles. You might be a 90-year-old pensioner or you might be a 20-year-old billionaire. But I've told you what I currently own. Doesn't mean you should buy it straight away. What you should be doing is looking at value, growth, income, and so on. But they have such rapid growth. I'm worried that I buy at the top. How do you weigh that situation up? Well, Joseph, what I look at, regardless of market conditions, is what's value, growth, income, cash flow. I'll give you a view on that one. I don't want to do this for every single stock because everyone's going to start throwing numbers and stocks at me. But let me just look at which ones I've got. Home. Let me just search that one. Find Square. Let me tell you what the ratings are. Bang up to. Oh, I can't find what I'm looking for. Great. Here we go. Full Square. Find next. There we go. Square's dropped on a value growth income to a 6. And I'm afraid the cash flow's dropped a bit as well. So whilst I hold it, I'm sitting on a healthy profit. I'll hold it for 12 months, which will probably be up in a month or two anyway. but I wouldn't right now have got it. And so in the last 6 months, it's given me a 50% return. In the last 6 months, I haven't got what it's given me in 12 months on my database right now on there. What else we got? Jasminda, no, I've answered that. Thank you. Apologies. Sean, no, of course. I looked at, this is not a recommendation, KEJE. You said, what's my top share? I remember looking at MedPace, just about a week ago, not a week ago, 2 weeks ago. Okay. So, but you know, it depends on appetite. I do have double leverage in CDW, Charlie Delta Whiskey. Double leverage in that. MedPace. Doesn't mean it's suitable for you. It's suitable for my risk appetite. That's for sure. I still have no problems having double leverage in Microsoft. And you might think you're nuts. Why would you do that? Well, because I'm looking at a 12-month and probably a 24-month and 36-month holding in that one. And so I'm not trading my investments, remember. Get this. This is really important because statistically it shows you shouldn't trade. You should trade your trades, invest your investments. Don't mix it up. And when people mix up strategies with the other things, that's when they mess it up. They mix one thing up the other. Any other questions I haven't answered? Is there anything at all I have not answered? Anything at all? Please let me know. I'm going to go right to the top. Anything at all I've not answered, because I don't ever want to leave people and not having answered absolutely everything. I want you to know when you're on my webinars, you get total value. Sorry, if you're having trouble, that's where you go. Sorry, if you can't log in, I think there's a spot left. There might be one if you still can't. That's where if you want to wire it, because I know some people can't on credit cards put some of those sums. So if you want to wire it, that's what it is. We've had a phenomenal feedback off it. So alpeshpatelreviews.com if you want to see that. If you want to see the reviews in your own leisure. If you want to speak to me, just email me. Not a problem. Jay, Alpesh, is there dividend tax for US stocks held in a UK tax? In an ISA, I believe there's a negligible amount of withholding tax, but I don't personally. Think about it. The dividend yields at the moment are around 2%. They're pathetically small. So given we're trying to get a 40% return, if out of a 2% dividend, they were even to take, and they don't, 50% of your tax, that'd be 1% difference in your return. That's why you can see why I don't worry about it. Okay. Did you sell lots in March 2020 when stocks tanked? No, Saru. Great question, Saru. Remember what I said in March 2020, and this is great. It was actually in February 2020, stocks tanked. What I said is I think there's a 60% chance the markets will fall going forward and only 40% will rise. Well, I was wrong. The markets rose after March, didn't they? So I was wrong. So Alpesh, because you thought there was more probability they'd fall, did you get out? No, because I just told you why I don't get out and trade the investments. Whilst I thought there was a 60% they'd fall, the 40% came about, the market shot up. So accidentally, I made lots of money. Oh, why? Well, because I did what I always do, which is I stayed invested in the kind of stocks which if the market continued falling, they would have fallen less. And if it rose, they rose. Because sometimes the market wrong foots us. In fact, guess what? Sometimes it's all the times it wrong foots us. That's why. That's why it's important in terms of what I'm saying. So I'm consistent with what I said, because you'll remember I gave a talk in Hammersmith in February, and in March I said I think there's 60% probability it's going to continue falling. I and everybody else, others said 70, 80%. I didn't foresee the market. I'm not trying to foresee the future. I don't know if this year will be up or down. I think it's going to be up because the amount of money going into the markets. Okay, I think it's going to be up, but even if it's down, guess what? The stocks I have won't fall as far, and what can I do? That's fine. But I don't want to be out of them in case the market skyrockets. So I don't trade my investments. Okay. On your guru heat map, they all pick different stocks. Any comment? Kid, no, this is actually, it's a really good, clever point you make, actually. So imagine, Chris, you said all these gurus that pick different stocks. Imagine there's 200 people on this call. If I speak to them one-to-one, every single one of them, they're all going to pick. They're going to have different risk appetites, different perspectives. So they're going to pick different ones. Also, don't forget, there might be 200 stocks which all fit my profile. I can't buy them all. So I might pick some, others will pick others. Others will have higher risk, lower risk. Warren Buffett has a lower risk profile to Carl Icahn. because there's a 50-year age gap between them. Not Carl Icahn, Bill Ackman. All right. So that's why they pick different stocks. What I'm saying is, kid, there aren't just 10 or 15 magical stocks everybody should own. It depends on their risk appetite. And it's a bit like picking a football team. There's a lot of good players out there to pick from. You know, there isn't one goalkeeper in the world you should have. There's probably 20 different goalkeepers you can have, and it won't impact your winning the championship because they're all just as good as each other. But you can only have one goalkeeper at a time, can't you? You can only have 15 stocks at a time is what I'm saying. So there might be 150 to choose from. So you might end up picking a different goalkeeper. So like that. That's what I mean. Ash Doobie said, what criteria do you look on whether to sell during your 12-month review? You just said it. 12 months are up. 12 months are up. Then you start again. And you look at the same criteria to buy. It might be the same stock is still got the buy criteria, in which case you won't sell it. You'll just keep hold of it. But on the whole, I probably will rotate out of it because it'll have given me a 40, 50, 60% return. And I'll think to myself, ooh, let's buy some fresh blood. That hasn't happened for a number of years, for instance, with my triple leverage S&P, with Amazon, Alphabet, Apple, Microsoft. Hasn't happened with those, obviously, but with others. Yeah, Cadence Design Systems. Well, no, Cadence isn't a good example because I did own that about 2 or 3 years ago and then rebought it and kept it, as it were, in there. So that's that. Fahim, or trailing stop loss, exactly. If it falls 25% from the peak, within those 12 months, I'd also look to get out. That's just to give me a, so I know ahead of time what my worst case scenario is. Jonathan, working for a financial services company, you are asked to hold for at least 30 days. Can you have a trading strategy with a minimum 1 month holding period, or is it best to 6 to 12 months? Jonathan, we're talking about investing for your pension, so we're looking at 12 months. There could be trading strategies for a day, a week, a month, but that's trading. Let's not talk trading in this because we'll confuse people. We're talking investing. Phil, Alpesh, you're always really helpful. Thank you very much, my friend. My pleasure. Anil, do you add more to investments during market drops? It's a brilliant question, Anil. I would add more, obviously. When would I add more? If I've got more capital coming in, which happens. Of course it does. Happens to you, happens to me. So the simple answer is yes. I also add more, as Fahim knows, because I'm doing this program. So I don't just pick them in, say, March and then never buy anything for the rest of the year. Because I'm doing this program and I want people to know I put my money where my mouth is, I keep buying different ones during the year for the sake of my students. So they know I'm not just theoretical or theorizing as well. So in those scenarios, I do, yes. But I don't add, let me put it this way, I don't add to my losing positions just because they've fallen. The only time I would consider doing that is if my 5 quality stocks were to drop 25%. So for Microsoft, Amazon, Alphabet, Facebook, if they drop 25%, then I would add to them. I've not had the opportunity to do that much because guess what? They don't want to do that. But others, I don't buy into them just because I don't basically. There's an old saying, losers add to losers. Jasminda, Tesla is too volatile. It's outside of our remit. Anything too volatile would be outside of it. I'll just put it into my database to see what it looks like. Sometimes I absolutely, oh, there we go. Computers. I'm trying to do too much. So Tesla, I'll have to go soon because I've got a beautiful wife waiting for me. There we go. I'm on the wrong one, aren't I? There we go. It's over there. Fine, next. Tesla is on a value growth income rating only a 5. Cash flow, as you can imagine, is under 10%. It's not in the top quartile of companies with great cash flow. So there's other companies with better cash flow than them. There's other companies with better returns in the last 6 months. There's other companies, not many with, for the volatility, a higher reward. Not many though, because it has got what's called a Sortino above 1. There's not many companies with the outperformance Tesla has, but the outperformance of the market it has historically is only one of a multitude of factors to consider. Cash flow is an important one going forward as well. So it's outside of our remit, I'm afraid, because of cash flow and volatility. And you might say, well, you're an idiot, Alpesh, because guess what? It's going to go. I'm not saying, it's like picking a football team. I'm not saying just because I pick my team and I win the Premiership that there aren't other goalkeepers out there or other strikers or other midfielders who are even better than the ones I picked. so be it. I'm just trying to get my return. I'm not trying to pick all the world's greatest stocks. I'm not saying which ones are going to be the top 10 best performers out of 9,000. That's not what I'm doing. I don't know. That'd be gambling. I might as well play the lottery if I've got that kind of crystal ball. I'm trying to get my return target. Focus, focus, focus on the goal. Anything else? Anything else? I think I've answered everything. I would probably say our biotech company is too volatile too. Jasmine, it depends on the biotech. No, not at all. Not necessarily. It depends. So remember, bottom-up approach is what we have, not top-down. So we don't care about the sector so much as bottom-up. Where do they fit in terms of value, growth, income? So volatility is very easy to look up. Okay. Dumb on perhaps, but do you invest in PE and or VC? Well, I run a private equity fund. So I do angel investments directly. I use Crowdcube for that to do angel investments. And I've occasionally, and Fahim, you'd asked me about this, and I posted it on my Telegram channel, my angel investments, what companies I've invested in. I can't remember it now. There's a whole bunch. Well, did I say a whole bunch? About 10. I use Crowdcube, the crowdfunding platform, to buy into those. And I do share what I've bought because obviously once I'm a shareholder, I want everybody to buy into them. So that's why. Is there an ETF that follows the weighted average of the top 500? Yeah, there's a S&P 500 ETF. It's called the S&P 500 ETF. So there is, Jay. There's actually many providers who give the S&P 500 ETF. There's many providers. Yes, Fahim. I did that with Zoom, doubled up, total 6 clicks. It did double up very quickly. How do you evaluate your higher risk stocks versus lower risk stocks using your growth value income strategy? Higher risk ones is volatility. Volatility is another word for risk. Volatility is the percentage by which a price moves. So higher the volatility, higher the risk. What is the definition of risk? Risk is by how much a stock misses its average return. For the mathematicians amongst you, it's the standard deviation. Higher the standard deviation around the mean, greater the risk. Because it's risk of missing something, risk of missing a specific return. Volatility increases the risk of missing a certain return. So I use the Sortino and volatility to measure risk on that. Any other questions? I really better go now. Okay, so last two. Jay, Alpesh, do you have a training program for trading? I do. I'll discuss that. Yes, indeed, Jay. Just email me. I'll sort that out. Bill says he can't find the book. Bill can't find the book. Okay, Bill. So Bill can't find the book. Bill went to alpeshpatel.com and Bill couldn't find that. Bill, my friend, what's going on? See that where it says free investing unplugged book? How could you not find the book? How could you not find that? How could you not? You went to alpeshpatel.com and you couldn't find it. How could you not find it? It says free investing unplugged book. You go there. Then you clicked on there and you did this, didn't you? And you did this and you did this. And it said investing unplugged book. The book. I can't make it clearer than that, my friend. I really can't. I can't. Sorry, I'm teasing you, Bill. Forgive me. I'm teasing you. As well, John, I will. Thank you very much for that. Listen, guys, I really better go now. Okay, I'm going to turn off the. Thanks for everybody who signed up. I will email you in just a second. So thank you, all of you who have signed up. Okay, appreciate it. I'm delighted. To see you on there. So that's always good. And let me stop the screen share. Okay, thank you all. Thank you, everybody who signed up. I am going to speak to you in a second. I'm going to drop you an email. If you can't sign up, that means they're all gone. If you want me to hold you a place, message me, because I can always try and hold it up when I've got more time and space. So just email me if you want me to keep a space for you. And just so I can't eat this late, mate. It's 8:30. I'm on a diet. I'm always on a bloody diet. Oh, happy St. Patrick's Day, kid. Yes, indeed. I went to a St. Patrick's party ages ago with an Irish friend of mine, and my God, do they know how to have fun? I don't know how to have fun. They know how to have fun. I say in broad generic terms, but if I wasn't Indian, I'd want to be Irish. If I wasn't British Indian, I'd want to be Irish. There'll be an irony in there somewhere. Someone's going to say that's ironic. But anyway, thank you all. Thank you, everybody who signed up. I will speak to you in a second. Absolutely delighted. Thanks, everyone. I'm going to get going now. Email me if you want me to hold a space for you just in case, or you want to chat to me. Thanks a lot, everyone. Thank you.